Hi, good afternoon. I'm Ross from Kim Smith 150 Group Property Accountants, and we're going to look at one of my least favorite topics today. We're going to look at the question that I don't like doing and I don't like getting. So it's your personal house becoming a rental. So just a little thing first, just be really careful with advice. I see this comes up all the time. Oh, we've got this property settling in 1 week. Yeah, can we get some advice now? Pretty much no, there's not enough time. So generally, if you want to get an appointment with a good lawyer, a good property accountant, a good surveyor, a good professional, you're probably looking at 2 to 4 weeks to get an appointment if you're not already a client. So just make sure you allow some time. Then if the recommendation is, for example, to set up a trust, it's probably going to be 2 or 4 weeks for your lawyer to set that up. And then your bank is going to take 2 to 4 weeks to set up the documentation after. So be very, very careful that, yeah, depending on what structure you need, what advice you need, that you need some time in there. And yeah, don't leave it to the last minute. So then this is the question I don't like, and I get it quite a lot. I see it quite a lot on forums all the time. I want to turn my personal house into a rental. So yeah, I've got a bit of an example to go through, and yeah, hopefully after this you'll come to an answer that maybe it's not such a good idea, and you'll perhaps see why I don't like it. So we've got my favorite character, Joe King. He's got a personal house worth 700,000. He's debt free. It's a 10-year-old brick and tile property, so hopefully some lower repairs and maintenance. He's looking at going off and buying a new personal house and this existing one becoming a rental. So obviously, what do we look at? We look at the numbers. We want to see how is this going to perform over the next 10 years and what does it look like? So it's a $700,000 property. Normally, there's still some costs to buy it. We might rearrange it. There might be a valuation. There might be other things. Maybe there's some sort of bank contribution, depending on what we do. But just to make it easy, keeping around the same cost. It's debt free. Um, but to start with, I'm going to look at this like a rental. I'm going to look at it, if we bought this for 700,000 debt, what does the property look like? So I've got no equity in start with, but we'll rearrange that as we go along. I've got 51 weeks. Just trying to be realistic that, yeah, it can be a bit harder to rent. You can get a gap and some vacancy. And maybe it's a really cool personal house, but maybe it's not a great rental. Maybe, yeah, there's not a whole lot of bedrooms you can rent out, might be a smaller property. So let's go with 480. 51 times 480, 24,000 rent, 24,000 divided by 700, 3.49%. So straight away in my mind, I'm thinking that's not a great gross yield. Auckland sort of is sitting in the threes. Hamilton, Tauranga maybe 4. Christchurch used to be 5, and that's where this example is based. But yeah, sort of slipping down into 4. But we know at 3.49, it's not going to pay the mortgage, so we're going to be struggling for cash flow. Then I've got expenses. Insurance is high in Christchurch. Interest rate maybe 4.5% fixed for 1 year at the moment. Got some property management, got some rates, got some repairs in there. It's still, yeah, 10 years old, so creeping up. Maybe I'm a little bit high, maybe 1,500. I probably haven't updated that in my PowerPoint. Maybe some education about property, joining Christchurch Property Investors Association, a little bit of travel. They're a Christchurch one and a Christchurch rental, so not too much. So if we bought this as a rental 700,000, we've got 24 in, 43,000 coming out. We're losing about 19,000. So that to me is hideous. It's pretty terrible. Ooh, I'm starting to push away from that. I don't really like that property now. I do not like those numbers. So then I'm looking at, is it subdividable? Is it beachfront? Does it have something amazing going for it? Is there amazing value added opportunity? And let's say there's not, it's just a stock standard cross lease or something like that. Why would you buy that to lose 19,000? And then the answer that everyone comes back is, oh, it's already my personal home. It's got no debt. We'll move on to that, but we'll keep looking at this for the moment. So it's losing 19,000. You'll get a little bit of chattel's valuation. So you generally get value it in, value the carpets, curtains, dishwasher, stove, heat pump, fences, decks, driveways, paths. It's always a great trick, always a great way to reduce our tax. In the old rules, losing 18 grand plus 2.5, losing 21, paying no tax. But then if we bought this rental now, it's existing, and presuming it's not somehow otherwise classed as a new build, we won't both claim the interest. So effectively we'd be 21,000 loss plus the 31 interest. We're actually a 10,000 profit. At 33,000, paying 3,400 in tax. At 39, we'd be paying about 4,000 in tax. Yeah, losing 18,000. So to me, this is looking hideous. But obviously it is debt free at the moment. So there's all that equity in it. So effectively there is no interest. It's making 12,000, less some chattels depreciation is 10, paying some tax, maybe about 3,433%, left with about 9,400. So at the moment you're going, cool, this rental's making some money. This is awesome. And yeah, we'll just explore that a little bit more. So there's no debt on it. There's low depreciation, repairs coming up. It's starting to get an older property. My numbers are just slightly different than I did then, but say there's tax 3,200, surplus after tax $9,000. But on the other side, you've got to go out and borrow 800,000 for your personal house. There's no deduction whatsoever because you're buying for your personal house. Say interest is 5%, just for example, 40,000 a year, you're losing overall 31,000. So is it looking so good now? All you're really doing is kidding yourself. The rental is looking good because it's got no debt, but all your debt is down here in your new personal home where it's non-deductible. So what would we do in the good old days? If you can remember those, we would set up an LTC, a look-through company. We'd sell the rental to the LTC at 700,000. The LTC would borrow 700,000. All the interest would be deductible. We would be happy as. But last year, back in March 21, the new interest deduction rules, deductibility rules, interest limitation rules came in. So obviously, if we sell it to an LTC now, that's a sale. So effectively, there'll be no interest deductions. If we get rollover relief, then we'd have to, there's no debt. It's going to carry on, no debt. And if we sell it to an LTC, we'd also get a new 10-year Brightline. So it would do absolutely nothing, not improve the situation, not help at all, but potentially get us stuck with a 10-year Brightline. So it's very difficult to do this unless it was a new build, then potentially you could look at restructuring it then. But for existing properties, yeah, it's just generally not going to work. So what's a better way to do this? How else could we look at it? And the better option would be, what about if we sold the existing rental, bought a new personal house, and then we buy a rental property? So Joe King sells his personal house for 700,000. He gets 700,000 cash. He buys his new personal house, puts in his 700,000 cash, is left with 100,000 of debt. That was okay. I was just checking that I was actually recording all the way through this. I had a terrible thought in my mind that I hadn't. So yeah, he's got 800,000 house, put in 700,000 cash, 100,000 debt left, and then he buys his new rental for 700,000. Is that sounding better? Let's look at the numbers again. So I have picked, to me, a terrible rental. This is not the best one. I'm definitely not telling you to go out and buy this. It is just a really average rental, average numbers. Yeah, it's not perfect at all. So yeah, this is definitely not a good rental. I'm definitely not telling you to go out and buy this property. It is just an average stock standard new build, which again, I would not touch with a barge pole. Yeah, it's an example from Christchurch that I recently did, probably about a month ago. It's a townhouse, 2 bedrooms, but there's a whole lot of other ones around it. They've each got one car park, which can create a whole lot of problems. There's no value add. You can't subdivide. You can't mine a dwelling. You can't add some bedrooms. It is brand new. Yeah, the developer's already maximized all the opportunities. So yeah, it's 700,000 as well. The rent was $520. If I was actually going to buy it, I would always talk to, I would never trust the builder, the developer, the property investment company with the rental appraisal. I would always do my own homework and chat to a couple of property managers to see what's the rent like, what's the demand like. Is there lots of people looking for 2 bedrooms? Is there lots just coming on the market at the moment? So this rent, 26,000 divided by 700, 3.78. So it's not amazing either. There's some expenses. There's no body corporate, which developers use a lot to try and say how great it is, but it creates a whole lot of problems. Can you actually get insurance, or does the insurance company want to insure them all? Who pays for these other expenses? Like if the shared car park, the shared gardens, the shared driveway need fixing, and how do you legally get that money out of them? Because it's not a body corporate. You don't have such good legal rights. Still high insurance. It's Christchurch. You've got some 4.5% 1 year. Property management rates, low repairs because it's new build. Again, some education, Christchurch property investors, a little bit of travel, but still within Christchurch, you're losing $16,000. And that's with interest rates at 4.5%. So to me, I don't know why someone would buy this. To me, this is just a straight gamble on capital gain. I think if I look at my numbers over a 10-year period, I've got it losing, it's 22,000 on average per year over the next 10 years, losing 200,000. And we were hoping that it was going to go up 500. So a huge gamble on capital gain. Possibly at the end of the 10 years, if you bought it, you'd be happy, but it's just, can you do so much better? Could you buy better than this? And I would really be looking for something better. But this case, like I said, not good numbers, losing 16,000, getting good chattels depreciation, ending up with a big loss that will just carry forward year after year until you've got some other rental income. So I haven't jacked these numbers up. I haven't tried to make them look good. This one's got deductible debt. It's got high depreciation. It's got low repairs. It's got no tax, but it's losing 16,000. And the other one was making 9, which sounds good, but that had all your 700,000 in it. This has got no money in it. So your personal house debt, instead of being 800, it's only 100. No deductions, interest at 5%. Instead of being 40, it's 5. So overall, with my very, very average example of a rental, instead of losing 31,000, we're about 9,000 better off and only losing 21.5. So in this case, it would have been much better to sell the existing personal home, and from a financial point of view, buy a new personal home and then buy this really average rental, and you'd have better numbers. So obviously what I'm saying is, don't go out and buy that average rental, but still sell the existing personal home that doesn't work unless it's got some really good opportunities. Buy a new personal home and then look, to buy a rental where you can add value, you can subdivide, you can add a room, you can add a minor dwelling, you can Airbnb it. Obviously watch GST on that. Rent by room, it's a bit of a harder one, but it can be an option if you're a real good property manager. Just different things to think about. Watch out in the comments. We've got a little group that we've just started off about a week or so ago, and just trying to help people grow their property wealth. So simple tips and tricks, lots of little things. Like we've just been over the last week looking at what little things can you do to improve your property value and to improve your passive income. We're hopefully going to have an expert speaking live on that as well. I'm just trying to confirm that. Next topic we're sort of looking at is about mortgages. How do you get one? What things can you do to make that easier? So and we're just going through that. We've got about 10 topics just to slowly go through, and it's all about growing wealth. So if you're not on that group, have a look. It's got some great information, and it's all just about you getting ahead. We don't sell property. We don't have a weird and wonderful package for 20,000 to sell you for mentoring. There's nothing like that. There's no sales pitches, just great information. So hopefully you enjoy that, and hopefully you enjoy the rest of your weekend. Thank you. Bye.